we have another goose egg of a day for U.S. stock markets, which have done absolutely nothing since last week's jobs report, ostensibly because what they're waiting for is the very thing that we are going to discuss today, U.S. inflation. This is Macro Money. I'm Elias Pivac, head of global macro here at tastylive. And the lack of conviction for investors here seems to suggest that what we are waiting for is the very thing that should give us clarity within the next 24 hours. And that is, of course, the US CPI report, with the key question being, will it sink stocks? Why are they so afraid of it? What is going on that is so scary? And so what we're going to do here is lay out the groundwork for what these numbers mean, why the markets are so moved to be afraid of them, and what they might actually be lining up to produce. So first, the expectations. The headline inflation rate is seen nudging up here a little bit, up to 3.4%. To put that in context, that would be up from 3.2% in February, and also the highest since September, where it came in at 3.7%. So this would be a meaningful upswing for CPI. For the core number, however, the direction of travel is in the other direction. Expectation is that the core rate, which excludes volatile food and energy, and not only are they volatile, but the Fed really has no agency there, so they're not especially relevant for monetary policy, if only because these are the prices that get set on global markets, and there's not a whole lot that the Fed is going to do with manipulating interest rates to stop the Houthis from attacking ships in the Red Sea or from people eating. So there's really not a whole lot there for the Fed to do. And in any case, those things, as we can see here, are relatively minor contributions. In fact, the uptick in the headline and the standstill in the headline more broadly, going back, let's call it the middle of last year, where we set a low at 3% for the headline, the kind of narrowing range since then, a sort of anchoring, if you will, that's happened as the influence of energy on the deflationary side has waned. And you can see that in the yellow bars there. The low in the solid red line occurs at the same time as the peak downdraft from energy, which shaves off 1.6 percentage points from CPI at the peak. In the most recent data in February, it shaved just 0.1%. So if we look at really how we got from here to here, it's this. It's this being very negative and then not, as rebasing continues, and of course the price of oil goes up. So if we're looking at the more expensive energy component of this being the reason headline goes up, that's not necessarily relevant for Fed policy, unless it were to show up in inflation expectations and impact consumer behavior down the road. But it isn't immediately something of concern. The core sliding here and largely reflecting the path of what's going on in this last vestige, this last holdout of sticky inflation, services, excluding food and energy, so core services, as it were. This is where the Fed is most going to be looking. And the decline to 3.7% is something that would be the lowest reading on core since really we were back in April of 2021, where the core was at 3% on the nose. So we're talking about a nearly 3-year low. And that would be something, of course, that would encourage what the Fed is looking at, because their calculus works something like this. Overall inflation has come down from about 9 to 3.4 if the forecasts hold. The core number has come down from 6.6 to under 4, but wage inflation has come down by less than 1%. And that's owing to still a lingering mismatch here in the labor market. So we can see here that, of course, at the start of COVID, there was a lot of oversupply of labor, 18 million as a matter of fact, because everything was closed, everybody got sent home. As we saw reopening from COVID, this got worked down and flipped to deficit. And we had a deficit of 6.1 million jobs as we went into 2022. That's been worked down to 2.3 million, largely because what the Fed has been doing has slowed the economy and got job openings down. But there hasn't really been a tremendous amount of firings or layoffs, and this is why the unemployment rate continues to be as low as it is. On Friday, it came in to 3.8%, again, within a hair of multi-decade lows. And so this is really the Fed's mission here, to get labor market demand down such that ECI, the employment cost index here, or really whatever measure of wage inflation you like, starts to come in and get us to 2% on the Fed's timeline. Now, why is this so critical for markets? Let's quickly review this chart, which we've been looking at for a while now, of course, and realize the makings of the stocks rally that we've seen since late October to early November seem to be all about hopes for cheaper future money. So when you see this rally start here, notice it is happening because the stock of Fed rate cuts expected for 2024, as baked into Fed funds futures, starts to grow. So we go from 75 basis points in cuts, which is where we are here. This is as the Fed says, we're done hiking, we're looking to start to ease. This starts to move out. The Fed doesn't define what this means, by the way, until right around here, when in December it says our baseline forecast is 3 cuts for 2024. Of course, they re-endorsed this on March the 20th. And this is what we have right here. We'll get to those expectations in more granular detail momentarily. But as rate cut expectations grow, the markets say, well, the money's going to be cheaper in the future. Take risks. If those risks go wrong, you can borrow back the lost capital for less. And so, not surprisingly, risk appetite swells, stocks go up. As this stops getting built out, notice stocks stop and pause to think it over. Then as the year begins, it seems the logic goes, well, if the Fed defined it as here and we think it's here, if we think there's going to be double the number of rate cuts, in other words, than the Fed is currently forecasting, future money is still going to be cheaper in relative terms. Risk on. And you get this continual climb here, even as the stock of rate cuts starts to diminish. Now, why is it starting to diminish? Well, since the beginning of the year, U.S. economic data has been performing better than expected. This is the Citigroup Economic Surprise Index showing data outcomes relative to forecasts. Notice Since the beginning of the year, data has increasingly improved relative to forecasts. And so, not surprisingly, the markets have said, well, hotter economy means less scope for disinflation, less scope to beat up the labor market and squeeze inflation out of it. So, fewer cuts. And this continues to keep sentiment elevated as long as there are more cuts than the Fed is saying. As soon as we get to durably less cuts than the Fed is saying, which is right here, stocks stop again. Which is why we are so very focused on this CPI data. If it gives us a core reading here that arrests this decline, if this number is any meaningful amount higher than expected, well, then we're probably looking at endorsing this view of markets that it's not 75 basis points that the Fed is going to do, it's more like 50. And then the equities rally might very well be in trouble. We can see the adjustments here. The line in the blue here is the 5-year US break-even rate. That's the difference between nominal and real bond yields. Real bond yields are just those that factor out inflation. And if we take the difference between those two, we can see the magnitude of that inflation adjustment. We can see that since the beginning of the year, against the backdrop of the better data, we get a steady climb in inflation expectations. We also get a steady climb in Fed rate expectations, both at the end of this year, that's the orange line here, and at the end of next year. That's the green line here for 2025. Now, notice this rapid downswing right here. There's a point at which the markets say, whoa, 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 whoa. Maybe it really will be more rather than less. But of course, what's going on at that very moment is a very telling thing. That is precisely the spot where what the Fed is starting to do is announce their policy intentions last month. That's that March adjustment. And what that's telling you is, well, we're going to stick with 3 cuts, even though the Fed is looking like they might need to do less. But since then, we can see it's continued to rebuild as inflation expectations have gone higher. And so too, the rates outlook for next year has increased. So the markets, really since the beginning of the year, have been in the process of trying to adjust to this. If we look at the way inflation has performed, these are annualized rates to give us the pace at which CPI is developing. Because, of course, if we look at year-on-year numbers, which is what we're looking at when we say 3.4 or 3.7, what we're looking at is comparing where inflation was 12 months ago with where it is now. But near-term dynamics might very well be more telling. And if we annualize those, we would get a better sense of how inflation is tracking currently. So, in the bars down here, what we have are monthly changes in CPI and core CPI. What we see is that the core is a little bit jumpier, but it hits a low in October, and it starts to edging higher. It's a little bit softer in February than it was in January, but there's very clearly the wrong direction that is being seen here between the monthly changes from October to February. The trend seems to be up. It's the same thing with the headline. Notice, much cleaner here, the headline numbers month on month keep growing. Now, if we annualized that, which is up here, the most eye-catching is, of course, the 3-month headline and the 3-month core, because this is the most recent. And as we can see in spades with the headline here and the core, they're trending higher. The 6-month annualized is a little bit flat, and the 6-month annualized core not really telling us a whole lot. It's basically a flat line. But at the 3-month level, annualizing it to show current inflation, there is clearly a pickup. And of course, what the Fed has said is that this pickup could be something, could be nothing. We don't know yet if it is a bump in the road or not. But consider where we are for the 3-month rate before it started to accelerate. In October, the 3-month rate was 387. It is currently 399, almost 4. In October, the core 3-month rate was 3.2. It is currently 4.2. So a full percentage point higher. So clearly inflation seems to be, at least on the 3-month view here, with this hotter than expected data in the first quarter, trending in the wrong direction. This is not the only consideration, of course, and probably a big reason why the markets are so jumpy. Just last week, we saw ISM service sector data. Service sector, of course, the largest contributor to U.S. GDP. The price component in that was woefully weaker than expected. In fact, we got the lowest pace of growth in that indicator since the low from March 2020 at the onset of COVID. And we can see CPI is tending to follow this with about a 3-month lag, which would suggest that there's a bunch more disinflation on the menu. However, not without a pop. So it's unclear yet if the markets are going to say, well, here's a pop, but we know it's coming, and then there's going to be a drop-off. This series, as you can see, can be quite volatile around the CPI direction, so getting that granular is perhaps a bit dangerous of a stretch to take. We do know that it seems like this inflation continues in the service sector in the coming months, though, which might defang some of the concern here if CPI comes out hot. Similar story comes from shock of shocks, wage inflation. In the red is that employment cost index that we saw earlier, having a hard time coming down even 1%, despite the more than halving of inflation rates, and the average hourly earnings rate of growth, which is the monthly version of this wages data versus the quarterly. And we can see that there is more tail here for this to decline. Just last week, we saw that average hourly earnings had fallen to 4.1%. That's the lowest that we'd seen it, again, since 2021. So it's looking like this is going in the right direction, albeit slowly. In fact, if we look at the monthly expected U.S. inflation averages for an indicator from the Cleveland Fed, and this is not averaging where inflation will be in 1 year, 2 years, 3 years. It's averaging what inflation will be as an average over 1 year, over 2 years, over 3 years, and 5 years. And if we see that the Fed's 2% goal is right here, we're just above it. We're very, very close across all of these. And so it isn't necessarily the case that the Fed is going to look at a hot number here and say, well, we need more cuts for sure. But that, of course, comes down to how the markets read it. And here we have an important lens to consider on top of CPI, because with it, mere hours later, we are going to see the release of minutes from that fateful March FOMC meeting. and see how policymakers tried to rectify this. Here is their official set of forecast updates. They are telling us here that indeed the data has been hotter, and so they've upgraded GDP expectations. The unemployment rate has been revised lower this year and in 2026, left steady for next year. Inflation expectations either steady or a little bit higher, both for the PCE, which is the Fed's favorite gauge, headline, and core. Probably the biggest thing here is the core was revised for this very year from 2.4 to 2.6. And yet, the Fed is sticking with 75 basis points in cuts. Consider if the rate is currently sitting where it's sitting, it's in a range of 5.25 to 5.5, so a median of 5.33. Then coming down to 4.6 is 3 cuts. They increased their longer run rate a bit, but that's not anything that perhaps we're worried about now. So the FOMC minutes will hopefully tell us how the Fed squares this, how they get from increasing growth and inflation expectations, but sticking with a 3-cut call, as though these revisions didn't occur. Now, when asked about this in the press conference after the meeting, Fed Chair Powell said, these upgrades reflect data that's already out, not data that's incoming. Oh, and by the way, we're also thinking of, in the relatively near term, slowing the pace of quantitative tightening, which is the runoff on our balance sheet, which is a kind of shadow rate hike effort that's not front of center, but continues to happen in the background. So really, it will most likely come down to digestion. Now, of course, we're not going to hear from the Fed to inform the market's CPI reaction instantly. What we will see is how investors react to the number. And what we know is they've already subsumed this information. They already know the Fed wants to cut 3 times and is saying, look, overall inflation is getting closer to the target. We're heading where we think we should. No reason to change things here. This reflects something that may just be a bump in the road. But the markets are clearly of a different view. They've been adjusting to higher inflation and higher rates in the near term because of what's going on right here. This is clearly a trend higher. So if the numbers come in broadly in line with expectations, and if the core number even manages to surprise a little bit higher in light of an economy that has been outperforming and so should give a little bit more of a nudge to prices on the upside, at the very least, what you get is an endorsement of where we already are, which is tighter than the Fed. And say to the Fed, when you update your summary of economic projections in June, you're going to have to go to 2 cuts. And that may be enough to tip stock markets over, because the catalyst behind the rally will have been spent down. And that is macro money for today. As ever, we are here from Monday to Thursday every week. Dressed After Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what is likely to happen thereafter. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Victor for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Good luck trading. See you tomorrow.